$1 meant $1 until it did not. On a Tuesday, in September 2008, a famous cash fund paid 97 cents. That crack, in a sacred promise, froze corporate payrolls in days. This is how $1 broke and how to protect your cash now. Stay with me. This is education, not financial advice. Money market funds look like cash, but they are investments. They aim to keep a stable $1 share price using strict rules. They hold very short-term debt like treasury bills, repos, CDs, and commercial paper. They are not bank deposits, and they are not FDIC insured. Safety comes from asset quality, maturity limits, and big liquidity buffers. There are flavors with different risks and uses. Government and Treasury funds hold treasuries and government repos. Prime funds can hold corporate commercial paper and bank obligations. Municipal funds hold short muni notes with potential state tax perks. In easy times, prime funds often yield a bit more than government funds. Before 2008, the rulebook let stable funds round prices to $1. They used amortized cost accounting and penny rounding inside tight bands. If the true value slipped far enough, the band could break. Most investors never noticed because funds stayed very close to $1. The reserve primary fund would change that. In 2000, 7 cracks appeared in short-term credit. Structured investment vehicles stumbled and ABCP markets wobbled. Big prime funds still chased a little extra yield in bank and broker paper. The reserve primary fund owned Lehman commercial paper. When Lehman failed on September 15, 2008, those notes went from safe to suspect. Redemptions hit in a wave as treasurers pulled cash. On September 16, reserve primary marked its NAV to 0.97. Breaking the buck turned worry into a full run across prime funds. Companies rely on commercial paper to fund inventory and payroll. When buyers vanished, that market seized and the real economy felt it fast. Policymakers moved in hours, not weeks. The Treasury announced a temporary guarantee program for money funds that paid a fee. The Federal Reserve launched a MLF so banks could finance purchases of high-grade ABCP from funds. The Fed also opened CPFF to buy new commercial paper directly from issuers. Liquidity returned and the panic cooled. The guarantee expired in 2009 and taxpayers collected fees, not losses. Regulators then tightened the design so $1 would be harder to break. In 2010, the SEC raised quality stress tests and maturity limits. In 2014, institutional prime and institutional muni funds had to float their NAV. Retail prime and government funds could keep a stable $1, but with fees and Gates tools. 2020 delivered another live test. The dash for cash sent outflows surging even in safe markets. The Fed opened the money market mutual fund liquidity facility. CPFF returned for issuers and markets stabilized again. It was a reminder that design helps, but panic moves fastest. In 2023, the SEC rewrote parts of the rulebook again. Daily liquidity minimums jumped to 25% of assets. Weekly liquidity minimums jumped to 50% of assets. Hard redemption gates tied to liquidity were removed because they spooked investors. Institutional prime and institutional tax-exempt funds gained mandatory liquidity fees when outflows surge. So what does this mean for your cash in 2025? Government or Treasury money funds sit on the cleanest collateral. They target a stable $1 and hold very high daily and weekly liquidity. Prime funds can be fine, but take corporate issuer and run risk. Institutional prime NAVs float, so $1 is not a promise. Here is a plain English checklist you can run tonight. Read the fund name because government or Treasury usually means safer collateral. Scan the holdings mix for T-bills, repos, and agencies versus corporate paper. Check the expense ratio because low fees keep more of the yield. Confirm the daily and weekly liquidity percentages are well above the minimums. Know whether the fund can charge a liquidity fee in stress and when it would apply. Understand how cash moves inside your brokerage. Your default sweep may be a low-yield bank program, not a money fund. You can often switch the sweep to a government fund manually. For large balances, compare a dedicated government fund to short T-bills bought directly. T-bills settle quickly and can be laddered 1 and 3 months for steady access. Let us pause on what actually made $1 break. There were 2 risks that combined at once. Credit risk hit when Lehman paper lost value. Liquidity risk hit when redemptions sped up and forced sales. First, movers' fear amplifies both risks in any pooled fund. Design aims to mute those feedback loops. High daily liquidity lets funds meet redemptions without selling riskier paper. Weekly liquidity gives managers time to reposition calmly. Floating NAV for big prime funds spreads small price moves every day. Liquidity fees make remaining investors safer during a rush. Now the household playbook in 5 lines. Emergency funds belong in insured deposits or government money funds. Known expenses inside 3 months can sit in a T-bill ladder. Money you might need in 3 to 12 months can use government funds or short bills. Do not stretch for a few extra basis points in prime if you need absolute stability. Match the tool to the timeline and sleep better. The small business playbook is similar but stricter. Keep payroll and vendor cash in government funds or T-bills only. Write a short policy that defines sweep settings and authorized movers. Run a 48-hour bank outage drill once a year. Document a backup payment. Rail in case your primary portal jams. Cash is oxygen and policy beats improvisation. Let us do a clear number example for a family. Suppose you hold $25,000 for emergencies. A government money fund yields close to policy rates minus a modest fee. A 3-month T-bill ladder may match or slightly beat that after fees. Pick the fund if you value same-day liquidity. Pick the ladder if you can wait a day and want direct Treasury exposure. Now, a business example with payroll risk. Your firm needs $300,000 twice a month. Use a government fund as the operating bucket with buffers above the weekly liquidity cutoffs. Hold extra working cash in a T-bill ladder that rolls each week. Avoid prime exposure for payroll unless your board signs off in writing. Map the timing so redemptions and maturities line up with payroll dates. Here are common myths you can now ignore. Myth: cash in a money fund is insured like a bank account. Reality: money funds are regulated pools but not insured. Myth: breaking the buck happens all the time. Reality: it is rare and rule changes made it rarer. Myth higher, yield always means better choice for cash. Reality yield without liquidity can be a trap when you need the money. Do this quick audit once per quarter. Open the fund fact sheet and skim top 10 holdings and liquidity. Verify the expense ratio and compare to a low-cost peer. Check that your sweep setting still points to the fund you intend. Make sure beneficiaries and authorizations are updated for accounts that hold your cash. A short history snapshot locks the lesson in your head. 2008 Lehman fails and a prime fund breaks the buck. Treasury guarantee and Fed facilities stop the run. 2010 rules tighten quality and maturity. 2014 institutional prime funds float NAV. 2020 dash for cash and a new Fed facility. 2023 liquidity raised and gates removed. 2025 investors have safer options if they choose wisely. What should you watch going forward? Spreads between prime fund yields and government fund yields. A big gap can tempt investors to take more risk late in the cycle. Commercial paper, market health, and dealer balance sheets. Stress there can ripple into prime funds fast. Policy headlines about liquidity, fees, and fund reforms. Rules can change, incentives and your best choice may shift. Here are your 3 keepers before we wrap. Know exactly what your cash vehicle owns and how liquid it is. Prefer government or treasury money funds for true cash needs and use T-bills when you want maximum control. Treat cash like a system with rules, not a feeling you check only during a panic. If this gave you a clear plan to keep cash safe while it earns real yield, subscribe now.